Welcome to the October 2020 edition of This Month in Payroll. I'm Rowan Geddes, the National Leader of PwC's Payroll Consulting Practice, providing the latest news and updates affecting payroll in Australia. This month is Budget Month, and accordingly we're spending time exploring the impacts of the federal budget on the payroll community. In addition, the Tax Office released statistics last month regarding the success of the SG Amnesty, which we will explore, while the Fair Work Ombudsman released their FY19-20 Annual Report, which is always interesting reading. And finally, we are delighted to announce a special guest speaker this month at our next Payroll Leaders event. But first, the federal budget. The federal budget for the 2021 financial year was released on the 6th of October, delayed by 6 months to give Treasury more time to better understand the economic fallout caused by the COVID-19 pandemic. The budget directly prioritises job creation and support, and there will be an expectation of payroll to help deliver this. We've already experienced this with JobKeeper, where payroll has helped deliver more than $100 billion to support around 3.5 million people. Yes, people in payroll should pat themselves on their backs. The payroll-related changes that were included in this budget are the JobMaker hiring credit, the boosting apprenticeship commencements, changes to personal income tax rates, and changes to superannuation portability. From an employee perspective, the centrepiece of the government's budget is the new JobMaker hiring credit. The government projects that this new credit will help support the employment of 450,000 employees, which represents 3% of the current workforce. The JobMaker hiring credit is a credit provided to eligible employers of $200 per week for every eligible employee hired who is aged between 16 and 29 years, and $100 per week for eligible employees hired who are aged 30 to 35 years. The credit is available for 12 months after every eligible new job created between 7th of October 2020 and 6th of October 2021. This credit will be paid to employers quarterly in arrears from the Tax Office, starting from the 1st of February 2021. The JobMaker hiring credit presents a couple of complexities for payroll, which we will explore. But first we will run through the logistics and the eligibility requirements. From an employee perspective, employees, casual, permanent and fixed term, will be required to complete a nomination form when they are hired, declaring that they meet the employee eligibility for the credit. Employee eligibility is that, at the time of hiring, they were aged between 16 and 35 years old, had received job seeker payment, youth allowance or parenting payment for at least one of the 3 previous months, and have not filled in a JobMaker hiring credit nomination form for another employer for whom they are still working. From an employer perspective, employers will be eligible to claim the credit provided they are not receiving JobKeeper, they are up to date with their tax lodgement obligations, and they are not a Commonwealth, state or local government agency or subsidiary, or an employer subject to the major bank levy. Employers then need to satisfy an additionality requirement on a quarterly basis. This requirement is that there must be A, an increase in the business's total employee headcount from the reference date of 30th of September 2020. Note that this is an employee headcount test rather than an FTE headcount. And B, that there must be an increase in the payroll of the business for the reporting period as compared to the 3 months prior to 30 September 2020. This increase must be greater than the size of the JobMaker credit claim. Where the employer qualifies for the JobMaker credit, they will then be able to make a claim for every eligible employee that is hired, provided that the employee works for a minimum of 20 hours per week averaged over a quarter. The JobMaker hiring credit presents 2 complexities that payroll will need to consider. First, headcount numbers. Those who are involved in making claims for the recent New South Wales Jobs Action Plan payroll tax rebate may recall some of the challenges of tracking whether headcounts had actually increased across the business. For the JobMaker hiring credit, we will need to test this quarterly to see whether employee headcount numbers have increased compared to the 30 September reference date. And B, hours worked by an eligible employee. Payroll will need to advise whether eligible employees worked more than an average of 20 hours per week for each quarterly reporting period. Because this is based on an average hours basis and doesn't apply to all employees, the tracking will require an out-of-cycle calculation by payroll. While the administration behind this initiative should not be as onerous as JobKeeper, it is still going to require attention and management by payroll and HR. For those with large casual workforces, this could become quite a significant impost. Registrations for the JobMaker hiring credit will be open for eligible employers through the ATO online services from December 2020. Employers will be required to report quarterly that they can continue to meet the eligibility requirements. Boosting apprenticeship commencements. Similar to JobMaker, the Boosting Apprenticeships Commencement Wage Subsidy will support employers by providing a subsidy to any employer that engages an Australian apprentice after the 5th of October 2020. The subsidy is 50% of wages paid to an apprentice up to a maximum of $7,000 per quarter. The subsidy is capped at 100,000 places and is not available for apprentices receiving other forms of Australian government wage subsidy, such as JobKeeper. Another centrepiece to the federal budget was the bringing forward of personal income tax cuts, backdated to 1 July 2020. While employers will only be required to apply the changes to future payments, the government has made it clear that it expects the impact of the personal income tax cuts to be passed on by employers immediately, to put more cash into people's pockets and to stimulate spending. The new PAYG withholding rate tables have already been released and are applicable from the 13th of October 2020. Payroll should expect that their system vendor will release quickly, if not already, a patch to reflect the new PAYG withholding rates in their payroll systems. Payroll functions will then be required to undertake appropriate system testing as a matter of urgency to ensure that the tax cuts are passed on to employees as soon as possible. Finally, there were also a series of changes proposed in the budget around superannuation reform. Of note was the proposal to staple employees' superannuation funds to them, not my words. This proposal is designed to help employees avoid the creation of unintended multiple superannuation accounts. Under the proposed rules, which are due to come into place on the 1st of July 2021, an employee's super fund will follow them from employer to employer. Employers will facilitate this by obtaining information about an employee's existing superannuation fund through the ATO's online services and paying into that fund. Under these proposed rules, the employer will only pay the employee's superannuation into the employer's nominated default superannuation fund if an employee does not have an existing super account and does not make a decision regarding a fund. This proposal has generated mixed views in the industry, with the Financial Services Council, which represents bank-owned and retail super funds, in favour, and the trade union-linked industry superannuation sector wary. So this reform is still a watch this space. Superannuation Guarantee Amnesty statistics. The SG Amnesty closed on the 7th of September, and this month the government released statistics regarding the impact of the government initiative. Under the program, 24,000 employers found they had underpaid approximately 393,000 employees $588 million in unpaid superannuation, plus interest. This covers about 1% of Australian employers and 3% of Australian employees. 70% of the amnesty claims were lodged in the last week of the deadline. Amazingly, 7,000 amnesty claims were received on the last day. These numbers far surpass the government's estimates, with Assistant Minister for Superannuation Jane Hume explaining that the government was expecting the one-off amnesty would return $160 million, covering 14,000 employers. And so, now that the amnesty has closed, the question is, what's next? Well, first, the ATO faces the unenviable task of processing all of these claims. The Tax Office has a goal of 28 days to process the amnesty payments and has already processed more than 75% of the payments. However, given the volume of claims lodged in the last week of the amnesty, we do expect that some employers will experience delays in the claims being processed past the 28-day goal. Secondly, what happens if an employer discovers a superannuation underpayment outside of the amnesty period? We still encourage you strongly to consider a voluntary disclosure. Although the benefits of the amnesty, tax deductibility, no administration charge, no penalties, are no longer available, the Tax Office does still have the ability to reduce the penalties from the maximum 200% to a lower number, potentially as low as 20%, if the underpayment is voluntarily disclosed. In contrast, underpayments discovered under audit are unlikely to qualify for penalty remission. Further, the ATO has been clear that audits of superannuation guarantee obligations will commence upon the completion of the amnesty period, so we are monitoring this for increased activity. The Fair Work Ombudsman's 2019-20 Annual Report. Finally, this month, the Fair Work Ombudsman released the 2019-20 Annual Report. Much of the annual report focuses on the Fair Work Ombudsman's enforcement and completion activity, particularly in its key focus areas: fast food, restaurant, cafe sector, horticulture, and franchises. However, the Ombudsman has included a section which is more relevant to this audience: large corporate underpayments which were self-reported. Last year, the FWO recovered $123 million in underpaid wages for 25,000 employees. This is more than 3 times the amount recovered in the previous year. $90 million of the $123 million came from businesses that had discovered the non-compliance of their own accord and volunteered that information to the FWO, reflecting the increased awareness by management and boards of the risks inherent in payroll and the steps that they are taking to proactively address this. Notwithstanding this, and recognising the impact the self-reported large corporate underpayments is having on the community, in FY19-20, the FWO brought in a series of initiatives. It has established a corporate sector task force that is dedicated to investigating large employer underpayments, written to the chairs and CEOs of Australia's largest corporations to seek their assurance that they have appropriate governance mechanisms in place to ensure their entities are and will remain compliant with workplace laws, and revise their compliance and enforcement policy, which sets out how they will approach self-reported non-compliance. This includes the use of enforceable undertakings. In 2019-20, the FWO agreed 9 enforceable undertakings with large businesses who self-reported non-compliance. The FWO called out 5 factors which they have seen as the cause of the large corporate underpayments, based on the disclosures last year. They are 1. Manual processes for recording hours of work. 2. Failing to apply an enterprise agreement for all employees it covers. 3. Failing to implement all the terms of a new enterprise agreement. 4. Applying annualised salaries that don't cover the award rates for the hours worked. And 5. Failing to undertake annual reconciliations where required. Of these, 2 stand out based on our experience with affected employers: timesheets and annualised salaries. First, if your business still uses manual processes for capturing your employees' time, I implore you to seek support to implement an electronic time and attendance system. Time and again in our diagnostic or remediation work for employers, we discover that manual timesheets have driven inaccurate or absent records, leaving the employer with exposure. Secondly, if you are using annualised salaries, I flag that you must still capture the essential data, for example, working hours, employee classifications, and do an annual reconciliation to ensure that the employees are still better off overall. While a respite may have occurred at the start of the year due to COVID, with regulators easing off on compliance activities, the ending of the ATO's SG amnesty, and the language from the FWO, who has called the scale of the self-reported underpayments by large employers extremely disappointing and concerning, reminds us that payroll is often the largest expense on a company's books, and so payroll functions by necessity manage large amounts of risk. Businesses must remain diligent about managing these risks through both providing adequate resources and training to payroll functions, and also ensuring that there are sufficient review and control systems in place to support the function. And before I wrap up this month in payroll, I am delighted to announce that on 29th of October 2020, PwC will be hosting a special event with Justice Ian Ross, President of the Fair Work Commission. Over recent months, we've seen the Fair Work Commission adapt at speed to the rapidly changing nature of employment, introducing interim flexibility clauses into awards, and supporting businesses with vexed topics such as stand-downs and applications of JobKeeper. As the impact of the pandemic stretches beyond 2020, the Fair Work Commission is now looking at the longer-term changes that Australia needs to help businesses adapt to a future flexible workforce. We are delighted to host Justice Ross at our upcoming webcast to hear his insights and vision for the future. If you're listening to this update prior to 29th of October, you're welcome to register for this webcast using the following link. And that's it for this month in payroll. If you would like to revisit any of our prior updates, they are available on our website at pwc.com.au/payroll. Should you have any questions or need for support, please reach out to myself or to your PwC contact. Until next time, have a great month.